Hi, I'm Chris Sugden, managing partner at Edison Partners and your host of Electrifying Growth. This is Sit Down with Sugden, where I share from my experiences as both the investor and an operator to help you get that next stage of growth.
Hey everyone, thought would be an interesting time to talk about constraints, and the abundance of capital often can be a misleading sign of success, or I like to say it differently, and that is capital doesn't solve problems or create innovation, people do. And I think sometimes the more capital you have, you throw money at what you think is opportunity, but you're really creating more problems for yourself than innovation. And so this idea of, is more capital a good thing? In my opinion, it's actually not. And a little bit of an Edison commercial or strategy link here as well. As you think about, we think about where we invest our money, we often talk about bootstrapped entrepreneurs or first institutional capital in a business is what we're looking for. Those rare companies that thought about building the company first, rare in tech, but not rare in the real world, non-tech. The idea that you sort of bootstrap a business, you sometimes have services businesses that turn into product businesses because you've sold your services, and then all of a sudden you realize these services can become a product. And so we at Edison have actually backed, generally speaking, 75, 80% of our companies had not raised capital before we arrived on the scene. And that the average revenue of our companies, this is over the last, call it 15 years or so, 3 or 4 funds, over 60, 70 investments. People think that's strange. 80% hadn't raised money, and yet their average revenue was just under 20 million bucks. You're like, how does that happen? And I think the venture capital world has oriented themselves to, I can't do anything if I don't raise a seed round. I can't do anything if I don't raise an A round. And there's actually a lot out there in the X-verse, I guess we say these days, not Twitterverse, some really good tech kind of influencers, content providers, et cetera, that are talking about this topic a lot more, that the tech universe is a lot bigger than Silicon Valley gives it credit for. And this ties to a second topic, which is a lot of times we also invest in underserved markets. So the idea that we don't invest in Silicon Valley, or we do invest in New York, we do invest in Boston, but we put 80% of our dollars in places not Silicon Valley, not New York, not Boston. And these entrepreneurs tend to think about solving a problem, building a company, selling to a customer before they raise their money. That's actually changed a bit because in the last decade, the availability of capital, the sort of, you use the word, the social media world has provided content that entrepreneurs assume they're doing it wrong if they don't raise a seed round or go be part of YC or some other incubator. They're somehow not keeping up with the other cool tech entrepreneurs. And I'd say there's a little bit of like, it's like the cool kids in high school, they're over there doing the Silicon Valley YC incubator thing, and the uncool kids are over here working out on their books or their instrument or what have you. And meanwhile, those are the ones, the geeks have taken over the world, as we know, because tech has taken over the world. So use that analogy today to think the outliers are the ones who are actually building their companies and not raising money. That is a framing or a backdrop, which can sound a little bit like a lecture. It's not. It's really meant to say, we saw this literally in this, what I call this unicorn birthing mode of the kind of 21 to 22, 21 to 23 time. The most very recent, we were all in COVID for 3 or 4 or 6 months. We were all in there for many years, but the first 3 or 4 months, it was like the world's ending. And then all of a sudden the world didn't end and everybody got funded, and the tech, world went crazy with funding companies, and remote drove, oh, we can go faster. We can innovate. Tech is going to eat the world. Innovation is really great. So you had this cycle, almost a super cycle of from Q4 2020 to the end of 22, maybe it bled into 23, that capital came fast and furious. And what you see now, we all see it, right? Many unicorns weren't unicorns. They were unicorns in valuation only. They weren't real companies. And so you actually see capital just didn't solve the problems. And there's a lot of very high profile failures and problems. And then you've got a lot actually right now happening, 24, 25. You've got financings happening that have had to adjust valuation. So I just hate that people label cram downs or recaps as really bad things. If you have a supportive set of investors that are willing to kind of keep investing in your business, even though the valuation was wrong, you ought to be happy that you've got people who are going to be supportive. That's a different topic, but let's focus on the topic of, does capital solve the problems? If you've lived in a company that's been a fast grower and even a modicum of success, you know that like the ability to hire people creates a lower bar for who gets to walk in the door. And that's some of the success, larger companies end up having bureaucracy layers, but even mid-sized companies, 100, 200, 300 people, you end up with people who start showing up and no one knows what they do. And everyone's looking around going, what do they do? And there's the feeling of 10 or 20% or 30% of the people are doing 80 or 90% of the work. I'm not sure that's all wrong, to be blunt, particularly in the sub 200 person company world. But let's look at a bigger company. Oracle, Larry Ellison's famous for every year, 10% have to go. Because 10% aren't meeting the standard. So that says right away, even big companies know, and we all know big companies are worse at this, bureaucracy and bloat and layers, and I've got a budget to spend. I think if you kind of just drill down to kind of smaller growth equity kind of companies, 10, 20, $30 million businesses that have just raised a bunch of money versus what they did before in terms of where they spent it or where they invested it. And that's the key difference is, are we spending or investing? And I would think in today's world, if you kind of think of that way to frame the conversation, if we can't measure ROI, we're probably spending and we're not investing. And so is it a layer of administration? We also see this in another way as companies get a little bit bigger, again, get past 50 and now get to 100, a couple hundred. You promote people to director or vice president or some other title. And because they're getting promoted, they need people. So you end up with a second problem, which is as I have more managers, I need more people that report to managers. And so the other thing that comes with, in some ways, too much capital and therefore call it inefficient spending is this idea that the more managers I have, the more people have to go work for them. And then think about the next thing that happens. Meetings. Managers have to have one-on-ones and teams have to meet. And so now I've got a group of two that have to have a meeting to talk about what the other person's doing when I can just walk over and ask what they're doing. So it sounds a little bit elementary, but we've seen this play. I personally seen this play over and over for 25 years of being an investor. And even my last company raised money back in the dot-com era on both sides of it. And when money's flowing freely, people tend to take it. And I'm not sure that's the worst advice. And I say that this way. The maxim or the adage that when someone's offering to give you money at a valuation that's attractive, you take the money. Don't be penny wise and pound foolish for how much you take. But what you do with the money is up to you. And I think so I'm sounds like I'm talking on both sides of my mouth. If someone's going to offer me 50 million instead of 40 million bucks in a round, I might probably guide someone to take the 50 as a board member, but it doesn't mean we're going to spend it because we've got it. And so it really comes back to what's the plan? It's one thing to raise a little bit more capital because things take longer and they tend to cost more, et cetera. It's another thing to throw money at problems is the simplest way I'd put it. But also we're in a cycle of board meetings right now, the way the quarter falls. And there are numerous meetings that happen at the end of a year where you have promotions and comp committees and raises. And one thing that another board member said at another company recently was, can we see the org chart? No, not just the C level, the ELT as some call it, the operating committee as others call it. Show me one level down and how big are the departments? And I'll be damned if you didn't find there was one company with like 8 departments of one, as in a manager plus one. That's probably creating some inefficiencies if you think about it. The other topic or kind of thread on this to think about to entrepreneurs, to founders, frankly, to board members who I'll say are less experienced, to the point about limitations and doing more with less. That's really what happens is you've got capital. And so now we don't have to be frugal because the capital's in the balance sheet. And so the idea that we're going to do the old zero-based budgeting, hot topic right now, right? Doge. And we know we can argue and people can be political. There's not as much fraud as Elon's saying, but everyone seems to be agreeing there's a lot of waste in the government. It happens to small and medium-sized companies too. The waste. Again, I actually think private companies don't have, we read about fraud, there's big deals, but take the fraud, waste, and abuse and take the F word out of it, a different F word, and think about the waste and abuse. That happens all the time. And I think it happens because this feeling of that we raise money to invest. Yes. Did we raise money to spend? No. And so again, I'll go back to the simple kind of axiom. Are we investing or are we spending? If we're investing, we ought to be able to measure ROI. And so maybe it's just one simple takeaway on this kind of topic is ROI can't be talk. It's measurable. So what's the KPI? What are we measuring? And how accountable are we to what we're measuring? And that's a simple way to avoid the trap of just spending money because we have it. So as we kind of keep pulling this thread of what does capital do versus, does it create more innovation? Does it create more waste, et cetera, or more opportunity for waste? But as importantly, in tech land and venture capital land, the idea that who led my round? How big was it? What was my valuation? All those things are important to some degree. But quite honestly, when I see that's the lead, as opposed to, I've actually said this for 2 decades, I still haven't seen the list. The list of the best tech companies or emerging growth companies should be the companies that have done the most with the least capital raised, i.e. the most revenue, the most profit. The inverse of what tends to happen. You get these lists because people have raised hundreds of millions of dollars. And I think there's a ton that goes into that around the founder or founders or CEOs sort of feeling like success is because I raised money from X and I raised this much money from X. So X led my round and it was Y dollars and it was Z valuation. That's an immediate turnoff for me. And I think there's some degree, I get it there is a different mindset. I don't like the West versus East, but I do like the Silicon Valley where it is in some respects, billion-dollar, multi-billion-dollar or bust. Don't bother because I'm going to change the world or not. That's not bad. And if everyone understands that's the game we're playing, fine. But quite honestly, most entrepreneurs aren't building their company with that in mind, but they get sucked into that's the only sort of paradigm they know because the Valley tends to get the most, the oxygen in the room is coming from there in terms of tech world. So this is not a knock on Silicon Valley and it's not a knock on a venture capital landscape that relies on, amazing businesses and amazing outcomes. But for 90+% of the world out there, the entrepreneur that's building a company, that's building a B2B software business to solve a problem that can look small in the grand scheme, but not so small if it's a few $100 million or $1 billion TAM, right? The ability to go build $100 million company in it's $1 billion or $2 billion TAM is actually quite possible. But if you're going to build a $100 million company, you should be raising $100 million bucks. Right? So the point is, I think ego and kind of identifying yourself as I'm successful because I raise money, it does become a cult of personality problem. And the problem with that is if things don't go as planned, you've got to raise another round, the stakes get higher. Now, back to my point about valuation and the idea of recaps, and I might continue to go up into the right versus I've got supportive investors and I can keep building the business I'm trying to build and changing the world in the way I'm trying to change it. Yeah, ego does play a role that we all have to be careful of. And every CEO, every entrepreneur, we all have egos. I have an ego, but how you use it, the Daily Stoic, and a shout out to Ryan Holiday, the ego is the enemy is one of his books. And if we could all be such good Stoics, but that's a whole different podcast and effort. But the point is, who's checking you? Who are you relying on to tell you you're doing it for the wrong reasons as an entrepreneur? One of the things I also like to say on this sort of topic is it's lonely at the top. And you're a CEO, you're a founder, you're building your business, you're raising money. If you're super successful, no one tells you the truth, right? But sometimes if you're failing, no one tells you the truth because everyone wants to avoid the bad outcome. The point is neither of those are the right answer. The answer is, do you have a coach? Do you have a mentor? Utopia is the board of directors that's really highly functioning, that's giving really good feedback, and it's candid, it's transparent, etc. Sometimes that can be wishful thinking, and I'm probably the Chris Sugden of 15 years ago would be, but the board can do all that. The answer is the board sometimes feels like it's evaluating a CEO and there's a command performance and they can't be quite as transparent as they should be. Wrong answer, but that's the reality. So you got to have somebody else that can be a sounding board if you're a founder or entrepreneur to go, quote unquote, check yourself. Am I doing this for the right reasons? Am I doing this because this is how I validate my worth? It's tied to the capital and constraint topic in many ways, because if I've raised a big round initially, it means I got to keep raising big rounds going forward if it's my ego, versus if it's the right thing for the business, I'm matching my business need with my capital formation strategy. So all this is kind of this vicious circle or cycle you get into if the reason you raised the big round was just that, to sort of brag about the round I'm raising versus what I'm building or what I've built, more importantly. Like I said earlier, I'd love it if entrepreneurs build it first, but I know that's not always possible. And again, there is a place for early stage, for seed investors, for companies to raise first, a big place for it. But frankly, for 90+% of the tech universe and really entrepreneurial universe, not just tech, that's not the right answer.
Thank you for joining this episode of Electrifying Growth. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. investors.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.